Hey, good morning, everybody, and welcome to this Thursday, April 18th, 2024 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we take a look at the action from yesterday and look ahead to what we might expect today. Futures right now are actually up across the board, but just fractionally so, about 2 to 3/10%. Dow leading. And I believe the Nasdaq may have been laggard this morning, but they're all fairly close. Usually that's not the way bottoms are carved, though. Normally, when we finish on lows like we saw yesterday, normally we at least go down and put it in intraday lows. So I generally don't trust these, morning advances when you're in a downtrend. But we'll see how things shake out today. More and more earnings coming out. CSX, one of the big railroads, reported yesterday after the bell, came in ahead of expectations on earnings by a penny, beat revenues. Stock is up a little bit, but that's a chart that we're going to be looking at a little bit later in the show. Not looking good. Transports broke down yesterday, not just below the 15.4 level that I was watching, but also that 15.2 level, which I thought was a much, much more important level. So transport's not performing well. Can't really sugarcoat that one. Again, we'll look at that chart in just a bit as well. Economic reports continue for the most part to come in pretty strong. Initial jobless claims this morning, I think we're at 212,000. We're expecting 215,000. Came in better than expected. We had the Philadelphia Fed Manufacturing Index that came in ahead of expectations. We do have existing home sales out later this morning at 10 a.m. And it was on Tuesday that we came up with very, very weak housing starts and building permits. Housing starts were really weak. So higher interest rates for longer, maybe starting to have a little bit of an impact on the economy. And this is going to be a little dance, I think, that the Fed's going to have to do if they want to remain adamant against inflation. And if they truly believe inflation could continue to be a problem or could even, begin to accelerate again. I do agree that that is their first mandate they have to take care of. You cannot let inflation get away. But I'm starting to see a little bit more cracks in the foundation, especially when you look at that housing starts number and some, other things, through the economic reports that really make me a little bit nervous. Like I said, we've got the existing home sales out later this morning. And then we also have leading indicators. Both of those will be out at 10 a.m. Eastern. Be a good idea maybe to check to see how both those come in and how the market reacts to it. Another big story right now is the 10-year Treasury yield. I'll be honest, I was really perplexed yesterday, maybe even shocked to see over a 24-hour period the 10-year Treasury yield drop from 4.69% down to 4.57%. And the IWM didn't budge to the upside, very little. Actually had a little spike, but 24 hours apart, 10-year Treasury yield was down 12 basis points. And the IWM, which has been almost perfectly inverse over the last several months with that 10-year Treasury yield, small caps did not use that drop in rates to bid up those small cap shares. So that'll be another thing I'll be watching today, because all of a sudden that did not trigger any buying in the small cap space. Anyhow, let's go ahead and take a look at what happened yesterday, and then we'll take a look at some of the charts heading into today. So the Dow Jones Industrial Average yesterday down 45 points. We had the S&P 500 down 29. That was down about 0.6% on the S&P 500. So we're back down to 5,022, which is a little bit more than 4%. The Nasdaq down 220 points yesterday, down 1.24%. And from the high, the Nasdaq's down more like 5%. Mid caps down 0.8%. Small caps down 1.06%. Transports down 1.7%. And there you can see all of these prior support levels. And there were about 5 or 6 of them between 15.2 and 15.4. And literally just this week, taking out all of it to the downside. And notice that volume really accelerated yesterday. AD line really weak, much weaker than just about any of the other indices. So it's hard to argue bullishly right now for transports, especially seeing that price breakdown yesterday. We need a quick bounce back, reversing candle, something on the transportation group. Utilities down, or excuse me, up 2%. That was the big winner yesterday, while technology and real estate were the losers. Technology actually held up pretty well, especially when you start talking about higher rates due to possible, reacceleration of inflation. Normally, you would think that would really impact technology, but it had held up really well. Yesterday, though, was an exception. Technology did actually underperform all of the other 10 sectors, dropping 1.44% in the process. Real estate, though, just continues to be weak, continues to weaken further and further, and is clearly now at a 2024 low, and really the lowest level we've seen since back in November of late November 2023. Airlines, this was interesting because transports took a big hit. Airlines were the best group yesterday, up almost 6%. So really big move there to the upside. UAL had reported strong results. UAL, and I don't remember I didn't see where it finished, but I know intraday UAL had a really good day. Anyway, airlines up almost 6% yesterday, but look at the truckers. JB Hunt, at this point, I would probably give JBHT, which is a trucking group or trucking company. I would probably give them the award for the worst earnings report so far in the quarter. They missed revenues. They missed by quite a bit on earnings, and I think they took the entire group down with them yesterday. So if you're wondering why transports broke down, you can blame it maybe generally on the truckers and more specifically on JB Hunt. Semiconductors down, closing below that 50-day moving average. So this is a group down 3.58% yesterday. It's been on fire since October of last year. It's really been on fire for a lot longer than that. But that run that we had from late October 2023 through February 2024, it was led by the semiconductor group. And now we are certainly seeing that change a little bit, which is okay. Group's not going to go up. It went up probably about, I'm kind of guessing here, but it looks like 80%, maybe 85% in 4 or 5 months. That's unsustainable. I mean, you can't go up 80, 85% every 5 months. So this is a group that needed some consolidation. It's been sideways consolidating, but I think yesterday was the first signal that maybe we're going to see a little bit more selling in that group than what we've been accustomed to. So again, borrowing a really big reversing candle today or sometime soon, getting back up above that 50-day moving average. I'm not saying there's going to be a massive sell-off in semiconductors, but it does look like wherever we go on this move to the downside is probably best case going to establish a low in a period of consolidation. That's what you want as a bull, is to settle low, come back up, go through the moving averages, and maybe for the next few months just kind of go sideways. Worst case, obviously, is that this move back through the 50-day triggers a lot more selling ahead. And I think all of this that I've talked about, which there are definitely more warning signs, no doubt about it. All of this combined with a volatility index that climbs above 20, it hasn't done that yet. But if it does, with some of these breakdowns, we could see selling accelerate rather rapidly. So what I've been saying, long-term investors, if I'm in this for a long haul and I'm not worried about the market for the next 5-10 years, I'm doing nothing. I see nothing that suggests this is going to be a long-term problem. If I am a trader, however, and you want to maintain capital, you don't really want to ride longs to the downside for very long, no pun intended. So you've got to watch key support levels. You've got to watch that VIX. Yesterday, I thought was a prime time to take a shot with leverage on the small cap index, thinking that we were going to possibly get a reversal. 10-year Treasury yield hit resistance. The VIX was up against 20 resistance. And of course, the 10-year Treasury yield did come down. There was also a positive divergence on the IWM on an hourly chart. So as it's been coming down, that hourly PPO has been going with it. Well, on that last low, yesterday, we actually had the PPO turning up on the hourly. So the IWM was showing me signs that, hey, this could be an opportunity. If that short-term positive divergence started to move back or started to generate more interest in the IWM and it started to gain some ground, that along with maybe the VIX coming back down from 20, the 10-year Treasury yield coming back down from key resistance after it made its cup with handle measurement, all of those things were suggesting, okay, now's a pretty good time. But as I mentioned to members, I got in, and this was discussed during our live trading room yesterday, but I was keeping a very, very tight stop. I wanted to see that reversal late in the day. We didn't get it. We actually closed on the low. So that TNA position that I had was in and out same day. And I went back into the IWM. And at this point, if that VIX closes above 20, I'm going to be out personally. I don't mess with a VIX over 20. If it reverses and the VIX comes back down below 20 and I have to buy in 1, 2, 3% higher, so be it. What I'm guarding against is a much, much bigger move where this could evolve like last summer into a correction of 10%, maybe more. I don't have a crystal ball. My signals are not telling me it's going to be that. But when you get into a period where you're expecting a decline, and that's what I was expecting in March, I was looking for about 4 or 5%. That's where we are right now, which is fine. The S&P 500, well, let's go ahead and look at some of these charts rather than just talk about it. I'll show you it on the charts. 10-year Treasury yield, let's get a quick update this morning. So right now we are up a little bit back to 4.61%. That is up about 2.5, almost 3 basis points. We'll see whether or not we can get back through that 470 level. I think, and you can see this 470 level right here. We gap down. I'm going to zero in here. So we gap down. See if I can get it all on one screen. No, I'm not going to be able to. Anyway, here's that 470 level over here. So we gap down to 470. The yield drops. We ended up coming back a couple weeks later. Where did we test? 470 before we then broke down and started this downtrend. Now we've come all the way up. We had the cup. I've talked about this. The breakout on the cup measured to 466. We closed at 466. And we also tested intraday 470. This is a big level. Short term, it's not as big as 5%, but this is the next biggest level right here at 470. So can we get through? If we do, and that means bonds are being sold. Now you sell bonds usually and drive rates higher if you're worried about inflation. You don't want to hold a 4% or 4.5% bond if you think inflation is going to pick back up from the current level, which is around 3.6, 3.7 annual rate. If that's going back up, back into the 4s or even into the 5s, and you're holding a 4.6% 10-year Treasury yield, you're not making any money. You're losing money, actually. So it's interesting to watch right now as folks have been selling these bonds and sending the yields higher. Watch 470. I think that's key short-term support. I think if we go through 470, I think we go back up to test 5. And if that happens, my guess is equity prices are going to be lower. So watch 470. That would be another clue. That would not be good for stocks. The VIX at 20. Let's pull this back. I'm going to go ahead and pull up the VIX. So you can see we moved up. Looks like maybe we're rolling over, but I've seen this before where it looks like you're rolling over and then you have one more surge. I need to see some price action on the stock, various indices that also supports that we probably have topped on the VIX. In other words, when I see semiconductors breaking down below the 50-day moving average, I don't get warm and fuzzies. When I see transportation stocks, and I'll show you that chart in just a minute, when I see transports breaking down below what I consider to be pretty significant intermediate term support, it's hard for me to get excited about the market in the near term. So there are still factors out there from a price perspective that I'm really concerned about in the market in the near term. And so if we see that VIX jump back up through the recent high and break through 20, you want to be careful. I've done a lot of research on the VIX. When it's above 20 and rising, the stock market sells off much more rapidly. So again, for me, it's not so much worrying about, okay, I might miss 2 or 3% to the upside. It's worrying about making sure I don't ride this thing down for the next 5% or more, possibly. So that's kind of the way I'm watching it right now. So we need a reversal pretty quickly here, or things could turn in the other direction. What's going to be interesting is when some of these big stocks, like Netflix, which reports after the bell today, begins to report. So we're going to have Microsoft and Apple and some of these big tech names coming out over the next couple weeks. Does the market care? I don't know. We're going to find out. Market hasn't cared about solid earnings so far because we have had a really good run of earnings for the most part. I told you about the JB Hunt and what it did to the truckers. That was an exception. We've been seeing some really, really strong results, but market seems like it's already been built in. Buy on rumor, sell on news. You probably heard that old Wall Street adage. Anyhow, let's move on. S&P 500. So we've broken below the 50-day, and you might say, okay, that's it, lights out. Well, I would move to the weekly chart and say we haven't even yet tested the 20-week moving average. So when I talked about back in March moving down 4 or 5%, that's kind of what I was looking at, was the 20-week EMA as a possible landing spot for our major indices on a pullback. So we haven't even gotten there yet. So we're teetering. I'm not saying things are bearish. I'm saying, yeah, we've got some things that look bearish. Semiconductors going below the 50-day, transport's breaking down. I mean, those things are definitely not bullish, clearly short-term bearish. But there's a lot of other groups still holding up really well. As bad as semiconductors are on the daily chart, breaking down below the 50, look at the weekly chart. I mean, we're seeing a little bit of acceleration, but we've probably, let's see, the rising 20-week moving average is 13,711. We've still got 900 points, which would be another 6% or so, maybe 7% on this Dow Jones US Semiconductor Index before we test the 20-week moving average. So yeah, the daily chart looks bad, but the weekly is the one that I pay attention to mostly from a long-term perspective. So that's why I'm still maintaining, and I don't have any signals, long-term signals really, that are upsetting me to any great extent. But that's why long-term I remain bullish. And I know somebody commented on one of my, I think it was either a question that came into earnings beats, or maybe it was posted a comment on one of my videos. But someone said, wow, Tom's not bullish anymore, or something like that. I don't remember the exact comment, but Tom is very bullish. I remain extremely bullish. We're in a secular bull market. I said it during the cyclical bear market, which I talked about beginning of the year before it ever even happened. I said it during the pandemic in 2020, in the middle of the pandemic. Everybody was fearful. Market was collapsing. I said, we're in a secular bull market. We bounced back. During this cyclical bear market, I said, during this cyclical bear, I said, we're in a secular bull market. And when this ends, we're going back to all-time highs. And that's what we did. During the correction last year, I said it was just a correction. We weren't going back down. Well, I'm going to tell you right now, I think this is a pullback. Does it reach correction status? Maybe. I mean, if the semiconductors lose another 7% to get down to that 20-week moving average, I would say we're going to be pretty darn close, if not to that 10% level. So very well could happen. But unless I start to see something really change in my under the surface signals that I like to use, I'm going to stick with what I've been calling for the last 11 years. All of these pullbacks, corrections, cyclical bear markets, there are opportunities on the long side. But if you don't have the cash because you ride it all the way down, that's a problem. So that's why I want to make sure that we watch a couple of key support areas and also watch that VIX. NDX, Nasdaq 100, clearly down below some key moving averages. We move out to the weekly chart. We're almost to the 20-week moving average now, very close. So the NDX, the 20-week is at 17,394. Let's go over here and take a quick look. 17,394, and we're at 17,493. So 100 points away, half of 1%, a little bit more than a half of 1%. We'll be on that 20-week moving average. The IWM, as I said, that was really surprising. When we took out the high yesterday, earlier in the day, or the high from the day before on Tuesday, I thought, okay, that could have been a reversing candle, and we had tested this gap resist or gap support. Let me annotate. And so this is the gap support that I was talking about. And this happens to line up pretty closely with that 20-week moving average being just a little bit below it. So if I just look at this right here, you can see that on Tuesday's action, we had actually gone down and filled this gap, which we had not filled since we gapped up back in, what was that, around February 13th. So we gapped up from February 13th and never went back and filled that gap until Tuesday. And we reversed off of it. And we had a chance to post a reversing candle on the weekly chart, which we still do, by the way. And we had the 10-year Treasury Yield topping or hitting an area where it could top. The VIX in the 19s up near 20. The positive divergence I talked about on the hourly chart, which I'll show you in just a minute. But all of that, you can see, was lining up for, in my opinion, taking a shot with leverage. Because if it didn't work, I could get out quickly. What I don't want to do is get into the TNA when the IWM is sitting about 3 or 4 or 5% above a key support level. Because the problem is if it goes down and tests that support level, the TNA is triple the IWM. So if you're talking about the IWM dropping 3, 4, 5%, the TNA, that's talking about 9, 12, or 15%. Those are big numbers. I didn't go back and calculate the exact percentage, but from me moving from the IWM to the TNA yesterday and back out of it probably cost me about 2% on the trade. But the IWM, if I had just held it, would have gone down about 0.6%. So I only lost about 1.4% on that trade by having the TNA. And I had my stop set. I was not going to back off of it. I wanted to see that reversal yesterday. Didn't see it. I wanted to clear. I wanted the IWM to close back above that gap support. Anything less than that, I was going to be out on the IWM. And it looked like we got within about 50 cents, or maybe might have even been a little bit above it. I think we were a little bit above it at one point in the afternoon. And so I was like, okay, this is perfect. This is going to be the rebound I was looking for. And then, of course, we saw weakness into the close. And again, as a trader, I don't care if you're long, short. If you're losing money, you got to have a stop. Doesn't matter what side of the trade you're on. You better have a stop in play. And it could reverse. I mean, when you get the VIX up into the upper teens or up into the 20s or 30s, I mean, head fakes are going to be everywhere. They're going to be, which is why I don't like to trade high VIX environments, because you think you have something 1 minute and 10 minutes later, it's completely different. And then you think, okay, I'm going to jump in on the short side. And all of a sudden you get one of these big rallies. And then you're like, well, and everything, you start to second guess everything you do. I would rather just sit out. And then I don't have to second guess anything. So if that VIX gets above 20, definitely keep that in mind. So that was the reason for the trade yesterday on IWM going into the TNA. I hadn't traded TNA in a while, but I thought it was worthwhile yesterday and did not pan out. Next up, okay, transports. So this one I want to annotate, and we'll also zero in here a little bit. But this was the level that I was watching at 15.2. I mean, there's also this level up here at about 15.4. See all these bottoms over the last few months, 15.4. These bottoms right here at 15.2. These bottoms were more important because we had broken out of this bottoming head and shoulder pattern. So 15.2 was the neckline. We went through it on very heavy volume and continued moving up. First, we went back down, tested 15.2, and then broke out to another high. Came all the way back down, tested 15.2 again. And you can see since this point, we have been in this sideways consolidation range. That was a bad candle. That is an ugly candle. This is 4 straight days now of red-filled candles. The volume yesterday accelerated. The 3 previous days were moderate volume. They weren't light. But yesterday we had big volume and broke down. So can't make many excuses for the transports. That was an ugly candle, and it was definitely a breakdown. Again, could it rally? Yeah, market can do anything it wants. But what we use technical analysis for is to manage our risk. When you see a big volume breakdown, that's telling you there's a lot of risk to the downside. So whether it recovers from here or not is a moot point in my view. It's telling us you got to be careful with the transport group right now, especially the truckers. And like I said, we'll look at the CSX chart in a minute. But they reported great results yesterday and earlier. They were up pre-market. We'll see where they are now. But I'm not going to trust that move up to the upside, not with what's going on right now in that space. All right. Before I go, actually, I'm going to go back to that IWM because I wanted to show you that hourly chart and that positive divergence. So you see here, we go down, PPO's down, we go down again, PPO goes down. Here we go down to another low, PPO goes lower. And here we are down at a new low with a higher PPO. Now, word of caution, because if you had looked at this probably back on April 12th, you would have said lower price. And April 12th, we would have been right here. You would have looked and said higher PPO. You would have said positive divergence, which in theory is correct. The problem is, after we had this quick little bounce, we ended up going lower and lower and lower. We never got back through the breakdown level. So, yeah, I mean, it definitely showed us temporarily we had a positive divergence, but the price action never confirmed anything. We never got back through the 20-day. And ultimately, what happened? The negative or the positive divergence was eliminated. And we talked about this with divergences on Monday of this week. We had a session, an educational session on divergences. And when people look back, they don't see this divergence. Why? Because it's hindsight and you had more selling. But again, if you broke it down on April 12th, that was a negative divergence. So for those who think, that these divergences always work, it didn't work there and it may not work here. I mean, right now we have that positive divergence, but what happens if IWM keeps selling off and this PPO turns back down and puts in a new low? It's going to look like there was never a positive divergence to begin with. So even though we have a positive divergence, you cannot I certainly don't like watching that IWM finish on the low of the day. All right, let's move on to the chart of the day. For those of you who are new to Earnings Beats, first of all, thanks everybody for following the show. We really appreciate it. Make sure you hit the like button if you like the video. Also, subscribe to our channel. All of that helps us. And once you subscribe, make sure you turn the bell on or ring that bell on notifications because anytime we do any kind of a show, it'll then pop up for you when you're on YouTube, let you know that we do have a show going. So anyway, make sure you check that out. If you want to subscribe to our service, obviously, we'd love to have you. We have a 30-day free trial. This requires credit card, but you won't be charged until the end of the 30-day period. And we will reach out to you before that 30-day period is over so that you can decide whether or not you want to continue with the service or not. If you're just brand new and you haven't already signed up for our Earnings Beats Digest newsletter, this is a free newsletter, no credit card required. Name and email address, all it takes. And then you'll get our newsletter, which is out 3 times a week. And if you're thinking, oh, no, I don't want another newsletter, it's 2 paragraphs in a chart. We call it a newsletter. It's pretty much like a chart of the day. So Monday, Wednesday, and Friday, you'll get a chart. And then you'll get maybe 2 paragraphs with it explaining the chart. Probably take you a total of 2 or 3 minutes to get through it, maybe 5 tops. And anyway, I think it'll help in some of your trading. Let's keep moving on. So today's chart of the day, I wanted to show you CSX. So CSX, along with many of the transport stocks, absolutely getting crushed. We've seen that death cross where the 20 crosses below the 50. You can see the PPO is very, very weak. It is reaching a level where we start to maybe see some prior, support in terms of the PPO, but we're not quite there. And I'm not getting in front of this freight train. Now, today we did come out with earnings. Let me give you the earnings number. It is 9:30, so I'm going to try and wrap this up real quick. CSX beat on revenue, on earnings per share, 46 cents versus 45 cents. They also beat on revenues, 3.68 billion versus 3.65 billion. And right now, let's get an update on the market. 34.16, now it's 34.57. Went up, pulled back to a new, at least below yesterday's low, and now has recovered back up again here all in the first minute or two. Unless we can get back through the 20-day moving average, there's not a whole lot to talk about here. I don't care how good the numbers are. If we don't get back and look good technically, I would stay away from the stock. So, yeah, we've got a chance. Get back up through the 20 with some news. Let's see if we can do it. Otherwise, watch below. If we can't hold about $34 on a closing basis, I mean, that's where we bottom there. That also is where we topped over here. 34 is a big level. So I guess if you're using price support, you could maybe make an argument that this is the time to get in. Nice result. I would just say transports have broken down. It's not an easy call. And if you do get in playing this 34 low, just make sure you keep that stop at 34. And he closed below 34, and I'd be very, very careful. All right, that is it. Let's go back and take a look and see how the major indices are doing. I see a bunch of green so far. Dow up 150, S&P up 12, Nasdaq up 20. So on a percentage basis, it drops with each of those three. Small caps up about 0.4%. So getting off to a decent start today. Let's just take a look at that IWM last thing we do here. Yeah, I mean, it's up. We'll see what happens. I mean, yesterday we were up. Monday we were up, finished down. Yesterday we were up, finished down, closing down near the lows. So while it's great to be up, let's see how we finish. It's all about the finish. I want to see a really strong finish. I want to see a reversal. I want to see a clearing of this trading range. I want to see a clearing of that 20-week EMA. It's still got a long way to go here. I'm sticking with the market for now. And again, that VIX, right now it's just below 18. If it were to break down back into the 16s, I would start to feel much better. Until then, I think we're just in this, I don't know, back and forth period, and we'll see where we end up. Last thing, 10-year Treasury yield, still up a little bit, 4.60%. And we'll see how that goes and whether or not that inverse relationship on the IWM continues, because that definitely was not an inverse relationship yesterday. I do want to mention also before I leave, got busy schedule coming up. So this weekend I'm going to be visiting with family. I'll still be doing some work, but I may not have the full complement of services, especially for the Earnings Beats members. The weekly market report that I normally have written out, the big one that I publish on Monday morning, I may simply do a video this week because I may not have the time on Monday. Remember, we have a another educational series on Monday. It's going to be on trading gaps. So if you're in that, and by the way, if you're a trial member at Earnings Beats, you can come into that for free. So all you need to do is just make sure you're a trial member. But that's on Monday evening. So I don't know if I'm gonna have a whole lot of time to do the weekly market report, because that's a long report. So I may just do the video this weekend. Next weekend is going to be a golf trip. I'm out. I leave Wednesday afternoon, and I'm not back until Sunday. So we'll talk more about that at the beginning of next week, but I just want you to know ahead of time for planning purposes. There'll definitely be no Thursday Trading Places Live next week. So anyway, I'll be talking more and more about this as we go throughout the week and weekend and into the early part of next week. But just want to let you know, plant a seed, that my schedule will be a little tight over the next couple weekends. Anyway, have a great day, everybody. Happy trading.